Hello, good evening students. So in this lecture, we'll discuss the important point. Most of the people are aware about something called as insolvency. So many people will know what is insolvency. Insolvency refers to inability to pay liabilities. Inability to pay liabilities. Our liabilities are more than assets. That is called as insolvency. That everybody knows. That is everybody knows. But that is the end result. That is the end result. But the beginning point is financial distress. So being a financial manager or being a CFO of a company, we should prevent at the financial distress stage itself. We have to prevent at the financial distress stage itself. If we are unable to prevent the financial distress, then it will result into insolvency. If we are unable to prevent the financial distress, then it will result into insolvency. Look at this. Continuous financial distress may result in insolvency. So financial distress is the beginning point. Okay, insolvency is the ending point. Therefore, we should not extend the financial distress. We have to take the timely action. We have to take the timely action. So financial distress, continuous financial distress may result in insolvency. Sir, what is meant by financial distress? How can I know whether a particular company is in financial distress or not? That is our next point. So our task is to prevent the financial distress. It should not result into insolvency. We should not prolong the financial distress. We should not prolong the financial distress. We have to take the appropriate action within the time. Okay. So now the important point is how to detect whether we are in a financial distress or not. What are the indications that our company is in financial distress? Are some other companies in financial distress, which you are going to value or analyze. Okay. So how can we detect it? How can you identify whether a particular company is in financial distress or not? That is what is our disappointment. So these are the indications of financial distress. These are the indications of financial distress. So first and more important point is cash flows not adequate to meet current obligations. Okay, so cash flows not adequate to meet current obligations. That means operating cash flows are negative or operating cash flows are less than your current liabilities. What is current liabilities? Amounts payable within next 12 months. Amounts payable within next 12 months are the current liabilities. Okay, amounts payable within next 12 months are the current liabilities. Whereas your your operating cash flows are the negative cash flow. Our cash flow statements, our cash flow statement depicts negative operating cash flows, reflects negative operating cash flows. Therefore, that is also one of the indication for financial distress. Next, our long-term loans are approaching maturity. Our long-term loans are approaching maturity, but the banker refuses to renew the loan. Banker refuses to give a second loan. The whatever the loan we have taken 10 years back, that is approaching maturity, but the banker refuses to give a fresh loan to repay that loan. The banker is not giving a fresh loan. Loans maturing without prospects of renewal, without chances of renewal. Loans maturing without chances of renewal. So we have issued debentures 10 years back. Now those debentures are going to be renewed. But in the market, we are not in a position to issue new debentures. That means the confidence about our company is decreasing in the market. The confidence about our company is decreasing in the market. That is one indication. Loans maturing without prospects of renewal. Next, higher interest payments. Higher interest payments. Whenever a banker or lender charges higher rate of interest, it indicates that the company is risk. So company is regularly paying interest and principal. Company is regularly paying interest and principal. Our account does not become NPA. Our account is a standard account. Our account is a standard account. Okay, regular account, no default in interest payment, no default in principal payment. But the very fact that high rate of interest indicates that something is wrong with the company. Why the banker is charging high rate of interest? Maybe you are not able to detect what is wrong with the company, which the banker has detected. That is the reason banker is charging high rate of interest. Be careful. Maybe you are unable to detect something wrong in the company. Banker, out of a tremendous research, banker has already detected something wrong in the company. So because of that, he was charging higher interest. Because of that, he was charging a higher interest. Okay, that is the point we have to catch. Higher interest payments. So higher interest rate of interest charged by the banker or lender indicates that something is wrong with the company. Okay, next. So whatever the terms and conditions of the loan, we are unable to comply. Our company is unable to comply with the terms and conditions of the loan. Say for example, at the time of taking a loan, banker will give some ratios, some key financial ratios. And he said that this debt equity ratio should not exceed 2:1. So debt service coverage ratio should be at least 2.25. This is what the banker may indicate. Debt service coverage ratio should be 2.25. Debt equity ratio should not be more than 2:1. So these are the ratios. Example, I'm giving the example. So those key financial ratios we have violated. Those key financial ratios we have violated. Whatever the ratios prescribed by the banker, our company is unable to cope up with those ratios. Whatever the ratios fixed by the banker, our company is unable to cope up with those ratios. That is first point. And next, bills of exchange is dishonored. Bills of exchange, popularly letter of credit, they are also dishonored. So one or it's not that every company will honor all bills of exchange. So once in a while there will be one or two dishonored bills. Once in a while there will be one or two dishonored bills. But if this dishonor continues forever, but if this dishonor continues continuously, our bills are getting dishonored, then something is wrong. Continuously, if our bills are getting dishonored, then something is wrong, obviously. Next, look at this creditors period extending. Creditors period extending. So important point, creditors period extending. I have to give that debtors period also. I forgot to mention. There are debtors period extending. I forgot to mention this. Debtors period extending and creditors period extending. Okay. So creditors period extending. So if the creditors are extending the extending credit period. Earlier creditors used to use a credit period of 1 month. Now the creditors are giving 45 days. Why? Is it because of out of love and affection towards the company? No. Obviously, is it they are doing some charity? They are doing some generous activity? No. Obviously, our company might have requested the creditors that we are unable to pay within 1 month or 30 days. Kindly extend it to 45 days. Based on our request, only creditors will extend. It is not that voluntarily they will extend. Who don't want money? If I am ready to pay money today, why whether any foolish creditor can say I don't want money today, pay after 15 days. No fool say like that. No fool say like that. So therefore, creditors are extending period means it is out of request from the company. Creditors are extending period means it is out of request from the company. Okay, so right, out of request from the company, creditors are extending period. That means if the creditors are extending their credit period, it indicates that the company is already in financial distress. If the creditors are extending their credit period, say from 30 days to 45 days, it gives an indication that company is already into financial distress. The company is already into financial distress. Next, on the other hand, if the debtors period is extending, the debtors period is extending. That means I am selling goods at 60 days credit period. Now I have extended it to 75 days. So it may result in future financial distress. Creditors extension period, it indicates that the company is already into financial distress. Debtors period extending, it indicates that the company may experience financial distress in future. It's a precautionary measure. Okay, it indicates that in future company may encounter financial distress. That is what the point. Okay, creditors extension indicates the past financial distress or present financial distress. Debtors extension period may indicate future possible financial distress. Next, some creditors are rejecting the credit transactions and they want the company to do for cash transactions. Some creditors are rejecting the credit transactions and they are expecting the company to go for cash transactions. Why? Because of lack of confidence about the company. Because of lack of confidence about the company, they are shifting from credit purchase to credit transactions to cash transactions. That is also one of the indication of financial distress. Next, falling margins. Very, very important. Very, very important. In today's competitive world, most of the new companies and startup companies, they are unnecessarily chasing the market share. They are in the mad race of market share. For the mad race of market share, they are unnecessarily giving too much discounts, etc. Because of that, they are getting huge losses. That is never ever a viable strategy. That is never ever a viable strategy. Therefore, ensure that your margins are proper. For a sustainable organization, profits are mandatory. Profits are mandatory. A company cannot survive long period with losses. A company cannot survive long period with losses. That is the important point. So for sustainable organization, profits are necessary. Don't go for mad race of market share. Next, sudden changes in strategy. Why suddenly the company has to change the strategy drastically, abruptly, radically? Something is going wrong. Something is going wrong. So they are not comfortable. Management is getting irritated. They are suddenly changing the strategy. Something is wrong. Okay. Next, senior management leaving the company. So earlier, before the outsiders, the top management people in the organization may detect something wrong signals within the organization. before the analysts and before the government detects financial distress, the senior management, they are directly looking at the financial position of the company. They are aware about the financial distress of the company. Therefore, slowly they will leave the company. So if you observe any company where slowly senior or top management people are leaving one by one, it indicates that something is wrong with the company. Okay. Next, suddenly the company is selling assets in short term. What is the necessity? Why you are forcefully selling the assets in short term? Why you are selling so much of fixed assets in the short term? Because you are unable to pay creditors. Because you are unable to pay creditors. That is the important point. We can manage the ratios. Company may manage the ratios. Therefore, you have to observe the transactions. Don't go by mechanical way of observing the ratios to analyze the health of an organization. We have to observe the transactions or activities of the organization more than financial statements. More than financial statements, we have to observe the transactions or activities of the organization. Because there are 101 ways to manipulate the financial statements. There are 101 ways to window dress the financial statements. So therefore, more than financial statements, focus on the activities of the company, focus on the transactions of the company. Why the senior people are leaving? Profits are good, debt equity ratio is good, debt service coverage ratio is good, everything is good. Then why the company is selling the fixed assets? Then why the senior management people are leaving? Ask the question. That is where the difference between knowledge and wisdom. Knowledgeable people will look at the financial statements. Wise people will look at the activities or transactions. Next, delay in reporting. Why the company is making so much delay? Why the company is not submitting financial statements to the various statutory authorities? Why the company is not submitting financial statements to various statutory authorities? Why there is a delay? Why there is a delay? So this is what the point. Delay in reporting. Next, discontinuance of dividend. Dividend is not mandatory. Even if the company does not pay the dividend also, financial statements ratios will not get affected. The financial statements appears to be stable. But why the company suddenly not paying dividends for the past 2 years? So company is established 30 years back. So till now the company is used to pay the dividend. For past 3 years, the company is not paying the dividend. Why? Sudden discontinuance of dividend. Something is wrong with the company. Something is wrong with the company. So these are only some examples. These are only some examples to identify whether the company is in financial distress or not. So therefore, our job is to prevent the financial distress resulting into insolvency. So how to avoid insolvency? Halting, that is stopping financial distress. So you should stop the financial distress at the middle stage. We should not extend the financial distress till the end. We should not extend the financial distress till the end. So these are the precautions. Prevention is better than cure. There is also saying that a stitch in time saves 9. Okay, if you take a prompt action within the time, right decision at the right time will prevent the 10 wrong decisions. Okay, so a stitch in time saves 9. Avoid mad race for market share. Avoid mad race for market share. This is the bad tendency observed in many of the startups. So rather than focusing on the profit margins and stability, in a mad race for market share, they are unnecessarily giving too much discounts. Unviable business models. Unviable business models. Long term, those business models based on discounts may not survive. Those on discounts or cashbacks business models may not survive. Okay, this is one of the reasons for failure of the messenger called as Hike. So this is I read in somewhere in research report. I'm not against any company, so it's not my personal opinion. I read in somewhere research report that one of the reasons for failure of the Hike messenger is cashbacks. They have given the cashbacks, but the moment the cashbacks has been withdrawn, gone. Nobody using that messenger. Therefore, it is not a viable strategy. We have to retain the customers through other methods. We have to retain the customers through other methods. We cannot rely on the cashbacks or discounts. So long as the cashbacks or discounts are giving, customers will come. Most especially in Indian context. Most especially in Indian context, we cannot rely too much on the discounts or cashbacks. We cannot trust the loyalty of the customers. Never think that in Indian context or Indian scenario, if you are giving discounts to the customers for 10 years, 11th year, if you drop the discount, suddenly the customers will go back. The customers will not show the loyalty, most especially in Indian context. Immediately they will shift to the other entities. Therefore, be careful. Avoid mad race for market share. Avoid too much debt. Avoid too much debt. Don't take too much debt and avoid lavish expenditure. Okay, keep a control on the costs. Okay, focus on every line item of the cost. Keep a tab on your cost. So avoid lavish expenditure. So these are the 3 important pillars to prevent insolvency. Okay, thank you. Thank you all of you.